Today we're going to really dig deep into a strategy that many beginner traders shy away from because it can feel counterintuitive, but in reality, it's incredibly powerful when executed properly: reversal trading. I want you to picture this. You've been watching a market steadily climb, candle after candle, day after day. Everything looks predictable. And then, the market hesitates. There's a subtle shift, a flicker of uncertainty. Some traders panic and exit their positions, thinking the trend is ending. Others see an opportunity. That pause, that hesitation, is where reversal traders live. That's where the real edge is. Reversal trading is not about riding the wave forward, it's about anticipating when the wave breaks and positioning yourself to ride the next one in the opposite direction. It's about being comfortable going against momentum, but not blindly. It's about pattern recognition, technical analysis, and psychological insight. And yes, it's high risk if you ignore your discipline. But when done properly, it can deliver outsized returns relative to the effort and risk. Let's start with a story. Early in my career, I spent months strictly following trends. I thought, if the market is moving, I need to ride it. And yes, that works. Sometimes. But here's the thing, markets don't move in straight lines. They pause, they fake you out, they reverse. I remember one week in the euro to pound sterling market, 3 false breakouts in a row. I followed the trend blindly, and every single time, I got stopped out. I was frustrated, but I learned a critical lesson: anticipating reversals requires patience, structured analysis, and respect for price behavior. Let's unpack what a market reversal actually is. Simply put, it's when the market changes direction. Uptrend becomes downtrend. Or vice versa. Sounds simple, right? But in practice, the market rarely makes a clean 180-degree turn. Often, you get a complex interplay of highs, lows, wicks, and volume spikes that test your patience and your conviction. Successful reversal trading is about recognizing the early signs before the rest of the market catches on. And here's a key point: reversals offer the best risk-reward potential, because you are entering near the turning point, not in the middle of a move where the profit potential is already partially realized. Now, how do we identify a reversal? I like to combine 4 elements: chart patterns, technical indicators, volume, and market psychology. Starting with chart patterns, let's visualize them together. Head and shoulders, double tops and bottoms, wedges. Take a head and shoulders pattern, it's elegantly simple. A peak, a higher peak in the middle, and another lower peak. That middle peak is the head, and the shoulders are the lower peaks on either side. This pattern visually tells you the uptrend is exhausting, sellers are becoming stronger, and a reversal could be imminent. There's a rhythm to it that, when you see it in real time, is almost like reading a heartbeat. Double tops are similar, they're like price testing the same resistance level twice and failing. You can almost see the market saying, "Nope, we're not going higher today." Wedges are a little trickier but incredibly useful. Falling wedges suggest a potential bullish reversal: the market is compressing, the downtrend is losing steam. Rising wedges indicate an uptrend reversal. Understanding the subtleties of these patterns is where intuition starts to develop, and that intuition is backed by repeated screen time and disciplined observation. Technical indicators are next. RSI, Relative Strength Index, is a favorite. Above 70? Overbought, potential bearish reversal. Below 30? Oversold, potential bullish reversal. But don't just take it at face value. I've seen RSI signals fail in strong trends. That's why you layer your analysis, combining RSI with MACD crossovers. Trendline breaks, and volume gives you higher probability setups. MACD is another powerful tool. When the MACD line crosses the signal line from below, you could have a bullish reversal. From above, a bearish reversal. But again, confirmation is everything. Volume analysis is where many beginners trip up. If price reverses on low volume, it could be a trap. The market might briefly flicker, and you jump in, only to see the move fizzle. But a reversal on strong volume? That's conviction. Traders, institutions, and algorithms are all signaling the same thing: the move has teeth. High volume confirms strength. Low volume warns caution. Now, here's where it gets even more interesting: the psychology behind reversals. Markets are human. Fear, greed, impatience, euphoria, they manifest in price action. Reversal trading is almost like reading a crowd. When you see exhaustion at a trend peak, or desperation at a trend bottom, that's when the smart money steps in. It's about sensing where the herd is likely to make a mistake and positioning yourself on the other side. Let me take you through a concrete example. There's a trader I know, John. He started as a pure trend follower. Uptrend, he's in; downtrend, he's short. But he realized he was leaving money on the table during reversals. So he shifted focus, studied reversal patterns, indicators, and volume. One of his most memorable trades was a major currency pair forming a double top. It had been climbing steadily. Price tried to break a resistance level twice and failed. The RSI confirmed overbought conditions, the MACD gave a bearish crossover, and volume was increasing. John entered a short position at 1.2, placing a stop loss at 1.21, just above the recent high. Over the next week, the market hesitated, teased him a little, but eventually dropped to 1.15. He exited, capturing significant gains. The beauty of this trade wasn't just the profit, it was the discipline. John didn't get greedy, he respected his stop loss. He didn't chase, he waited for confirmation. He adjusted in real time when subtle patterns developed. This is what separates professional traders from amateurs: structured analysis, disciplined execution, and risk awareness. Risk management in reversal trading deserves emphasis. Many beginners think, if I'm early in the reversal, I'll make more. True, but reversals are riskier than trend following because you're essentially betting against momentum. That's why stop losses are critical, and why limiting your risk per trade, say, 1 to 2% of your capital, is essential. Trailing stops can help protect gains, especially if the reversal extends further than expected. Reversal trading also teaches patience. There will be weeks where no setups are perfect. It's tempting to force a trade because you want to be active, but forcing trades leads to losses. One of my favorite quotes from Marty Schwartz comes to mind: every once in a while, the market offers a free lunch. Don't ignore it, but don't force it either. Reversal trading is all about waiting for the free lunch, the high probability setup, and then executing with precision. Another tip: keep a journal. Document every reversal trade you take. Entry point, stop loss, take profit, the pattern you identified, indicators, and the psychology behind your decision. Over time, you'll notice patterns in your own behavior. You'll see when you're forcing trades, when you're hesitating, and where your analysis is spot on. This self-feedback loop is priceless. Let me paint one more scenario. Imagine a market in a tight range, forming what looks like a rising wedge. You notice RSI is hitting 72. MACD is showing signs of divergence, and volume spikes on down moves. You anticipate a bearish reversal. You place your short, but then the market spikes up briefly, a typical fakeout. Many traders panic and exit prematurely. But if you've done your homework, your stop loss is in place. You stay patient, and within hours, the market moves sharply down, validating your reversal analysis. This is why preparation, risk management, and psychological resilience are just as important as the technical setup itself. Before we wrap, let's reflect on what we've covered. Reversal trading is about identifying turning points, combining chart patterns, indicators, volume, and psychology. It's about patience, discipline, and structured execution. It's about learning to anticipate rather than react. Done right, it can offer incredible risk, reward opportunities, and consistent profits. So here's my question for you. Think back to the last time a market you follow reversed unexpectedly. Did you act too early, too late, or not at all? What did you learn about your own patience and analysis? Share your experience in the comments down below, because understanding your own reactions is key to mastering reversal trading.
Thank you for listening to the Ultimate Trading Podcast by Bell's Forex AudioWorks. If you love this episode, hit follow, leave a quick rating, and share it with one trader friend. It really helps. Right now, head to bellsforex.com/tools. 6 professional-grade trading tools, 100% free, no sign-up. Use them on every trade. They're that good. Full guide is free at bellsforex.com or grab the Kindle version on Amazon. Until next episode, trade smart, stay disciplined, and keep building your edge. Happy trading!